Ladies and gentlemen, good day and welcome to the Q1 FY2024 earnings conference call of Syrma SGS Technology Limited, hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Bhumika Nair from DAM Capital Advisors. Thank you, and over to you, Ms. Nair.
Thanks, Michelle. Good morning, everyone, and welcome to the Syrma SGS Technology Q1 FY24 earnings call. I would like to welcome the senior management from Syrma SGS Technology and thank them for this opportunity to host the call. Without any further delay, I shall now hand over the conference call to Mr. Nikhil Gupta, Company Investor Relations. Over to you, Nikhil.
Thank you, Bhumika. Hi, very good morning to all. Welcome to Syrma SGS first quarter fiscal year 2024 earnings call. We have with us today Mr. J.S. Gujral, Managing Director, Syrma SGS, Mr. Jayesh Doshi, Director, and Mr. Vijay Agrawal, Chief Financial Officer, Syrma SGS, to discuss the performance of the company during the first quarter fiscal year 2024, followed by a detailed question and answer session. During this call, certain statements that will be made are forward-looking, which involves several risks, uncertainty, assumptions, and other factors that could cause actual results to differ materially from those in such forward-looking statements. All forward-looking statements made herein are based on the information presently available to the management, and the company does not undertake to update any forward-looking statements that may be made in the course of this call. In this regard, please do review the disclaimer statements in the earnings release and all other factors that can cause the difference. I will now hand over the call to Mr. J.S. Gujral, Managing Director, Syrma SGS. Thank you.
Good morning, ladies and gentlemen. It's a pleasure to touch base with you again for the quarter 1 FY2023-24 earning call. One of the significant milestones which we achieved in this quarter was our foray into the lucrative medical devices business by acquiring 51% of the equity stake of JDHL, which is Johari Medical Devices Limited, a Jodhpur-based ODM design company, which perfectly fits into our strategy. If you recall, in my earlier calls, when questioned on inorganic growth, we were always maintaining that inorganic growth will be guided by acquisition of a company which can help us in bridging the gap of our product offerings or has a regulatory approval which otherwise would take 3 to 4, 5 years. So on both these accounts, in terms of product offering as well as regulatory approval, JDHL comes out pretty well. It has about 15 to 18 FDA approvals. Its plant and processes are certified by the leading agencies of countries like America, Canada, Australia. It is a very strong and formidable footprint into the technology of medical devices. And we believe that with the global reach, the management bandwidth, and the financial mainstay of Syrma, this combination of technology being provided by JDHL and the management bandwidth by Syrma would enable us to grow this business significantly in the coming years. For your quick reference, this company has a turnover of about 160 crores last year, closed at about 160 crores last year, has been growing very rapidly over the last 2-3 years, has a EBITDA profile, a very strong EBITDA profile of 30% plus. We are acquiring the 51% stake at about 229 crores and plus a 28 crore payment based on certain milestone achievements. This acquisition will be accretive, not so much on the top line because our top line is very high already. So it may be a 5, 7, 10%, 5% accretive on the top line. But on EBITDA, it will be a significant push to overall scheme of things. Now, coming to where the organization will be structured, Mr. Johri will continue to lead the organization from the front as a chairman, and there would be adequate equal representation from Syrma on the board with reserve rights and controls. We would be devising the strategy to grow the company with the technological inputs coming in from the existing promoters. Now, coming on the Syrma SGS performance, it has been a satisfying quarter on almost all the parameters except one. The business of the company has grown by about 59%. The EBITDA margins have grown by about 64%, PBT by 73%, and PAT by 65%. And again, when we were earlier sort of interacting with the analysts and the investing community, we had maintained 3-4 parameters for our performance. One was growth higher than the industry average. We have come out reasonably well, if not I was sort of on this account. The second, we had said that we would have a gliding path of reducing the working capital cycle, and I'm pleased to share with you that our working capital cycle has now come down from about 89-90 days to 74 days on a year-end basis and less than 70 days on a average basis. So the focus of the management to reduce the working capital cycle has paid off results, as a result of which this quarter our OCF to EBITDA is about 50% plus. One aberration which has happened in this quarter is reduction in the EBIT percentage from 9% to about 7%. This is a one-off aberration because the healthcare business, which had picked up in Q4 of FY23, we had assumed it would be there in Q1 of FY23-24. It got pushed out by a quarter. And I'm happy to share with you that it has seen a rebound in July, and what we have the visibility for this and the subsequent quarters is that we will be doing about 30 to 35 crores of healthcare business this quarter, and then growing on that in the coming quarters. To give you a context of the hit on the sort of reduction in the EBITDA, Q1 of FY23 had a healthcare component of 55 crores. Q4 of FY23 had a healthcare component of about 45 crores. And Q1 has less than 15 crores, it's about 14 point odd crores. So there's a 40 crore reduction in the healthcare business compared to Q1 of FY23 and a 30 crore reduction compared to Q4 of FY23. Now, as the margin profile which we have been sharing with you, healthcare business is a high gross margin business and which hovers around 45%. So 40 crore hit on the turnover translates into approximately 17 crore hit on gross margins. And a 30 crore hit compared to Q4 is about 15 crores. So if we were to just sort of explain that figure into the existing figures which have come out, the margin profile is intact compared to the previous quarters. Now, on the business front, I'm very pleased to share with you that we have had our first major breakthroughs in US. Our EMS business was predominantly EU-based, and the RFID business was a mix of EU and North America. We have got a major contract for utility metering systems, and utility metering would include gas, water, and electricity. from a very dominant player in the world. And the initial orders which we have got, we are starting the startup production by Q4 of this calendar year or Q3 of this financial year. And this will contribute a significant portion to our export turnovers next year. So to some extent, this foray into USA in the EMS is de-risking the export business, because now it is in two geographical zones, which is the EU and North America. And going forward, this business would grow at a significant pace. I shared with during my annual earning calls that we have got the RDSO approval, so that thing is in process, and we are on track to execute the orders which we have got this year. Now, on the expansion, the CapEx front, I'm happy to share that in the first quarter we have done a CapEx of about 50-odd crores against a budgeted and CapEx of 200 crores this year. We currently have approximately 8.5 lakh square feet of manufacturing area with us. We have acquired a 16-acre plot of land from SIPCOT in Krishnagiri district, which is next to Hosur. And we have signed off an agreement for acquiring a 6-acre building plot in Chennai for the domestic business. Our Chennai plants are all export-oriented units currently. These two plants, when fully commissioned, will have a factory covered area of 1.5 million. So which is approximately almost 2 times what we are having today. In addition to that, we have signed off a long-term lease for a plant in Noida. It's under fit-outs and trial production. It's a 1 lakh square feet plant, and this plant is being dedicated for consumer electronics, and so that we can address the growing market of consumer electronics. From this plant, it will be a specialized, high-volume, consumer-oriented manufacturing, because manufacturing strategies and shop floor cultures of industrial consumer is quite different. So that's on the CapEx front. On overall visibility, we are still very bullish and confident of the growth numbers which we have projected. Q1 we have grown by about 59%. July we have grown about 47%, July to July. And we maintain that the guidance which we had given on growing greater than the industry with maintaining EBITDA in the double-digit margin, that by and large stands, and there is no significant challenge to that. So I can now give it to Bijay to run through the quick financial numbers and then open for question answers from your side. Thank you.
Hi, good morning everyone. Thank you for joining this earnings call today. I'll now take you through the brief financials of Syrma SGS and some bit of update on Johari Digital, the recently announced acquisition also. So I'm delighted to say that the company has registered a very strong growth of almost 59% year on year. So our revenue on a consolidated basis is approximately 620 crores for this quarter. EBITDA also demonstrated a very strong performance for this quarter at about 59 crore rupees, 64% growth year on year, and this is despite aberrations as explained by Mr. Gujral as of now. So we were able to sustain on the control on the cost side. PBT for this quarter is approximately 41 crores, grew by again 73% year on year, and same way PAT is 28.3 crores, again a 65% growth year on year. Gross margin for this particular quarter was slightly better by about 70 bps on a quarter-on-quarter basis, and mainly based on our efforts towards our supply sourcing cost optimization in a way. Coming to our order book, we have a total order book of approximately 3,500 odd crore rupees as on date in hand, and out of which about 2,200, 2,300 crore is something we expect to deliver in next 12 months' time. On the debt side, yes, we have a total debt of approximately 380 crore rupees as on June end, and out of which about 90 crore rupees is towards term loan, and 290 crore rupees is what we have used for working capital loan broadly. Capex side, Mr. Gujral has already updated that we had spent approximately 55 crore rupees in this quarter, and again the plan for this full financial year was approximately to spend 200 to 250 crore rupees, and that is still intact. On the capex side, what Mr. Gujral has already updated that we got a new land allotment in Hosur. So this was a project which we contemplated as a part of our IPO plan. So for this Hosur project, we got a land allotment from SIPCOT, and we had already incurred about 23 odd crore rupees during this quarter for that particular project. Coming to working capital, definitely this quarter we have a very significant achievement on our plans to reduce our working capital investment. And we were able to reduce our working capital investment by almost 40 crore rupees if we compare from March versus June. And again, in terms of number of days, when we calculate on an average inventory basis, our number of days investment is also reduced from 74 to 67 days. So there is a 7 days of investment. And again, we are targeting, so like we should be able to continue this plan as we contemplated previously also. OCF to EBITDA for us is about 45% for this quarter. And again, ROC is approximately 20%. That is when we calculate based on adjusted ROC after removing for unspent IPO proceeds and goodwill. Now, some update on Johari Digital also. As you know, we have acquired 51% of Johari Digital. This was a strategic move that strengthens our position in the fast-growing space here on the healthcare side. JDHL has also registered a very strong growth in terms of its revenue and very strong margin profile here, 30% plus kind of a EBITDA margin profile they are continuing. We expect this should help us in accretion of revenue on a full-scale basis, on a full consolidation basis by about 5 to 7% to the revenue side and about 1 to 1.5% on the overall EBITDA side going forward. In terms of funding for this acquisition, we plan to use IPO proceeds for this particular acquisition to partly we would be using internal accruals for this particular acquisition. So that was broadly on the JDHL side. Now I'll leave it to Bhumika to open for the question answer session. Thank you very much.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Venkatesh Balasubramaniam from Axis Capital. Please go ahead.
Yeah, thank you for this opportunity. Could you give us the breakup of, you said your net working capital days in your presentation at the end of the quarter was 69 days. Is it possible to give the receivable days, inventory days, and payable days at the end of the quarter? That would be my first question.
So, inventory days are approximately 81 days. Receivables are approximately 59 days and payables 74 days. So on that basis, we are at about 67 days of net working capital days.
But this would be the average, right? Can you provide the quarter end number?
Yeah, quarter end.
Quarter end also I can give it to you. Just 1 second. Yes, quarter end basis, my inventories are approximately 100 days. Receivables are approximately 67 days. And again, payables are approximately 95 days. So on a quarter end basis also, my overall net working capital days investment is approximately 74 days.
Okay. Now, are these numbers sustainable going forward, or you usually have like a low in first quarter which then increases?
So in terms of actual inventory, definitely with the increase in scale, it should happen. But what we see and the trend is specifically when we the recently commissioned plants, which we did in last particular financial year, those plants related to final full scale volume and revenue is happening. So we are expecting this should continue going forward also in this particular year.
Okay, understood. Besides this, is it possible to provide what was the customer advances on your balance sheet at the end of March 23?
That we'll have to check and we can share separately.
We'll have to get back on that, but there wouldn't be significant amount because normally the customer advances are only in case of a new customer where we have to commit some very dedicated inventory. For normal running products, the customers normally don't give advance. When a new customer is onboarded and if there's a specific part which I can use only for him and I can't use it, it's not fungible with other products, then we do secure our exposure. But Vijay will share it with you offhand.
Okay.
And on your question on the working capital, the management is seized of this issue. And I think what we had said that we'll have a gliding path to degrow this, reduce the working capital, net working capital. That endeavor will stand. Whether it is 68 days or 65 days, 1, 2, 3 days here and there, but there will be no aberration of going back to the old levels.
Okay, understood. Now, broadly, there were a couple of other things which I was keen to know. One is you said that you can maintain double-digit margins going forward. Now, when you are actually talking about that double-digit margins, you actually include the other income in your calculation and then talk about it, right? So, it will include the other income also in it.
The other income has two legs. One is the treasury income, and when we compare the margins, we normally exclude the treasury income and then share the margins. There are the other incomes which are related directly to the operations of the company.
Okay.
So the accounting standards say they have to be classified as such. When I buy a material, there's a cost which is based on the custom exchange rate. When I actually pay, it could be more or it could be less. So any fluctuation on foreign currency, whether on receivables or on payables, is directly related to that. Now the law is such that when I import, I have to book it based on the bill of entry rate. Now if the law was not that, and the bill of entry rate was based on the actual thing, then this thing would automatically get knocked off. So when we share the profile that will be about a double-digit EBITDA margin, it is with operating incomes related directly to the operations of the company, not the treasury incomes or not the miscellaneous income.
Okay, understood.
That's it.
Now, broadly, when you talk about...
Subramaniam, I'm sorry to
interrupt,
sir. I would request you to kindly rejoin the
Yeah, sure.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants in the conference, please limit your questions to one per participant. Should you have a follow-up question, please rejoin the queue. Thank you. We have the next question from the line of Ravi Swaminathan from Avendus Spark. Please go ahead.
Yes. Hi, sir. Congrats on the good growth that you have seen during the quarter. My first question is with respect to the gross profit margins. You had highlighted some points, definitely with respect to how we can improve the call earlier. But if you can double-click on it and say over the past couple of quarters it has been in the low 20s in terms of overall profitability. Is there a scope for this to improve significantly, say 25% or more? Given the fact that the industry average, if I'm not correct, so basically it may be in the 30s or something of that sort. Is there a scope for us to improve to those levels over the next, say, few quarters or a couple of years or something of that sort? And what can be the triggers for that? Increased ODM share, export ratios. If you can touch upon that, that will be really great.
See, we believe that with the product mix which we have, we should be able to maintain the gross margins at about 24, 25, 23, 25, around that percent overall. We currently do not see it going up to 30%. Okay. Should we be able to identify that how it can go up to 30%, I'll be most happy to come back and share with you. We currently are still looking at it, but we don't see a gross margin of 30% coming forward until and unless, again, this is a hypothetical question. If, for example, exports were to account for 50% of my revenue, then it will go up. But the current mix which we have, we believe it will be in the range of 23, 25, 26. That would be the range which will continue. The EBITDA would come in from the operating leverages as our businesses grow. If you see the Q4 operating overheads as a percentage of sales, there's a significant reduction. If we see Q1 of this year versus Q1 of last year, there's a significant reduction. I think there's a 3 or 4% reduction in the operating expenses as a percentage of sales. Exports, we would strive to be about 1/3 on a long-term basis. Short-term basis, it could be few percentages point down here or there. I think for this quarter, it was about 28%.
Got it. And my second question is with respect to the acquisition that we have done. The numbers of this company, both in terms of growth and margins, say in FY23, that you have mentioned is fabulous. I mean, from FY22 of, if I read right, it's 90 crores to almost 160 crores of revenue. That's almost like near to doubling in terms of revenue. And margins are also, you had mentioned that it was north of 30% EBITDA margin. First, is such kind of growth sustainable? What kind of growth that you foresee for this newly acquired business over the next 2 years? And this 30% margin is very high. Is it something which can be sustained in the medical equipment business side? Is it similar to the business that we do in the core business?
See, on the growth front, since the base of the company was very low, it has grown at 85% and 78% over the last 2-3 years. Honestly, when we acquired and when we evaluated this, we didn't factor this level of growth. On a conservative, we said if it was to grow at 25, 30, 35%, would it be a good bet for us? And we found that even if it grows at 20, 25%, it would be a very good bet for us, and it will fulfill a gap of medical devices, which is a very lucrative and growing business globally. So if we grow at 80%, that will be phenomenal, but we have not factored that growth in our analysis when we did the due diligence. On margins, I think 30%, hovering around 30% of EBITDA, whether it is 32 or 29 or 1-2% is always here and there. But we believe that for the near foreseeable future, we would be able to maintain EBITDA margins in this business at 30% plus. Now, the growth part, you see what happens in medical devices is you get your products approved from the regulatory agencies. Now, that is a long period for approval of the product. So currently, I think there were 15 or 18 number of products which have been FDA approved. And there are some more products in the pipeline. Now, till those FDA approval comes, we in fact believe we'll grow at 20, 25, 30%. But the moment if say out of the 10 or 8 or 5 or 7 products which are in pipeline, 3 get approved. Now that 3 will add a significant growth to the business. So it will always be a sort of a period that there will be a spike in the growth when new products get approved. Then there will be sustenance and consolidation of the markets. And then new products are in the pipeline. So it will be an ongoing cycle.
And just to add to what Mr. Gujral says, I think we should look at this as a platform for medical devices is what we have created. The idea is to create this platform of medical devices because it comes in with all the requirements of a US FDA approvals or a MDSAP approval, which is required for exporting to these developed countries. The idea is that whenever medical devices is conceived and pre-designed, co-created, the manufacturing it can be in India. And we can, as Syrma, support in terms of management, as Mr. Gujral has already said, management and bandwidth and the available facilities which we can really sustain. So I think we should look at this as a creation of a platform for medical devices which is significantly going to add value over 3 to 5 years is the way at least we have perceived this acquisition rather than just one-off of adding it to my things. And that's a vertical, as Mr. Gujral very said, that this is what we have been thinking strategically since last 1 year, and it's fructified today.
Got it, sir.
And
thanks a lot.
Yeah, just to add to what Jayesh was saying, now you see with the global reach which Syrma SG has, which we have, we've just announced, we've just done it less than 48 or 24 hours. So it gives us a platform, as Jayesh is saying, to go to big customers. You see, again, a 100 crore company on its own to go to a global giant would have an issue. But a 3,000 crore company going to a global giant in medical devices and offering its products, the confidence level of the targeted customer is much more when it is dealing with, say, a 3,000, 4,000 crore company. So we believe that this platform, it's a platform which we have acquired, as Jayesh has very, very correctly put it. Now we have to grow on this platform. And this growth, I can assure you, will be visible in the coming years. It's not a 1-2 quarter journey, it's a long haul, but this platform will give us a big leg up into the medical devices business industry, which is a very big and fragmented industry.
Thank you, sir. We'll take the next question from the line of Chirag Lodaya from Value Quest. Please go ahead.
Yeah, thank you for the opportunity. Sir, my first question is on the acquisition which we have done. If you can help us give some background about the promoter and, looking at the profitability, balance sheet, no debt, etc., it looks deal is, quite attractive or lucrative for us. So what led to this? Some color on this would be helpful.
You see, this Johri Digital or JDHL is almost a 79, so it will be, it's almost a 40-year-old company. Started by a husband and wife technocrats, Mr. Sindar Johri and his wife, and they have their design centers in Serbia. They are primarily a technology-oriented company and venture into manufacturing activities to satisfy the customer demand. Given an opportunity or an option, the current promoters would love to concentrate their time, spend their time in the lab to develop new products and not be bothered about the sort of day-to-day rigmaroles of running a manufacturing operation. This is where there's a very perfect strategic fit. We are very efficient into medium to high volume manufacturing, and the current promoters are very strong on technology. So it's a marriage of two. So going forward, we believe that we could leverage the strengths of each other with the product and the technological offerings of JDHL and manufacturing and marketing reach of Syrma SGS. It would be a formidable combination going forward. It will take time. It will take time to set up the distribution channels, the marketing channels, the whole strategy. But we are very excited about this platform which we have acquired. I don't say we have acquired a company. As Jayesh put it very rightly, we have acquired a platform for foray into a virgin area where Syrma SGS was not there.
And Chirag, one more thing, as Mr. Gujral said, that they are both promoters who are, design and technology savvy. They had earlier lived all their life in US. They came back to India when they realized the kind of growth in terms of medical devices have been, that why not India can really give these devices and technology and make it here much, much cheaper than what the US companies were doing it. And with that idea, they came back to India in 80s and started this company and set up their plant in Jodhpur. And they really worked on to ensure that how they can cater to the US companies. And today, if you look at it, their 90% of the sales is exports. So they actually have wanted to create a platform, as we call it, Make in India, or a manufacturing hub, medical devices hub. That's what at least their thoughts were when we were talking. And they said, why not partner to really make it big? That's where we are coming.
Right. Very, very clear, sir. Just a follow-up here. Two things. Do you intend to put any fresh capital here to grow this business, or it can grow at like 25-30% minimum without putting any capital? And do you have any right to take your shareholding up in near future, or this is what will be capping at?
See, on the capex part, since we have a very big presence in the electronic manufacturing, I don't think capex would be a significant thing, maybe something specific to it, or existing in the expansions which we have planned in Syrma SGS, they would be able to take care of all the capex requirements of their growth strategy.
And the capacity utilization is just 40% as of now, Chirag. So, apart from what Mr. Gujral has said, that there is enough capability to produce. And in terms of your second question, yes, I think we will see how this platform grows and then jointly decide on how we take over. So there is always an option to buy it, but that option will be decided at an appropriate time between the two parties.
Right.
And deleveraged company, strong balance sheet, deleveraged company, so that also is not an issue, even at the JDHL level.
So the company can fund its own capex in case it is required.
But going forward, I think with Syrma SGS coming on with big contracts, it would be sort of beneficial to consolidate manufacturing in the new hubs. Should the existing manufacturing area space capacity fall short, it will be consolidated or it will be migrated to the new hubs which we are starting.
Right. And in terms of the new order win which you have highlighted, utility metering system, how big is this opportunity for us, and how are the margins in this business? If you can just give some flavor, that would be helpful.
This is industrial thing, so the margin profile, it would be the industrial margin profile, which I think is about 23-24% gross margin. The initial figures which we have got are good. They're very exciting. And that's why I said that year 24-25, financial year 24-25 would be when you will see a significant leg up in our export revenues because of this contract. Current export revenues are about 25-30%, so on 600 crores. The export revenues for a quarter are about 180 crores. So when I say a significant leg up, I think it is quite clear that it would be going up much beyond the current level, the overall sales with this.
Right.
I can't give a forward-looking statement to be, but it's a big contract. It's a big contract, and we are very excited about it.
Right.
And this is again into, currently we have got orders only in the utility metering business. But this is a behemoth, and going forward, once we are able to demonstrate our execution capabilities, I am very confident that in the other verticals also we would get an entry. Yeah, Jayesh, you were saying something, sorry.
Nothing. That's it.
Yeah, just lastly, sir, on margins, if you can just call out, were there any one-off in employee cost in this quarter, and at a company level, X of other income, what kind of operating margins, we are comfortable guiding for FY24?
the employee cost in the first quarter, typically what happens when you complete a financial year, you do the reviews and all those things. And when you do the reviews, you don't amortize the reviews over the whole year. Whenever you pay it off, the performance-linked incentives or anything, you just charge it off. Going forward, as my revenues go up, the employee cost which is booked in the first quarter will not go up in the same proportion. So I believe that just as if you see the quarter ending March 23, my operating costs had come down, and I think it was about 15%, if I'm not wrong. Somewhere I have written. And going forward, and in this quarter, they are high. In this quarter, they are high because the revenues are low. On the margin, we still maintain the guidance that we would be striving to be a double-digit EBITDA on operational basis. And except for the treasury income, which is like the surplus funds of the IPO, all other incomes are related to the operation. There's nothing which is a rental income or a treasury income. We exclude the treasury income when we give our guidance of margins. Yes. And what we have shared with you now.
So out of 22 crore other income booked in the quarter, how much is related to business where you would like to attribute?
Yeah, Vijay will take that answer.
This other income actually, which is treasury income related number, is about 16.4 crore rupees, and balance is my other operating income, which is about 5.6 crore rupees, which is mainly foreign exchange fluctuations.
So when we say a EBITDA of 42 crores, we don't consider the treasury income, we only consider the operational income.
Okay.
If I were to take the treasury income, the EBITDA would be 59 odd crores also.
Correct.
So the treasury income is not factored when we calculate our operating margin.
Got it. Thank you and all the best.
Thank you. A reminder to all the participants, kindly limit your question to one per participant. Should you have a follow-up question, please rejoin the queue. Thank you. We'll take the next question from the line of Aditya Bakul from Tata Mutual Fund. Please go ahead.
Hi, sir. Good morning and congratulations on a great set of numbers, sir. Sir, just to take the last point forward, wanted a clarification. The EBITDA number of 59 crores that you've mentioned on slide 8 and 9, this includes the other income, which is treasury income, right, of 16 crores?
Yes. 59 crores includes the treasury income of 15-16 crores.
16 crores, yeah.
Without the treasury income, it is 42-43 crores is the EBITDA, operating EBITDA.
Correct. And what we are guiding for?
I have explained to you the aberration which has happened this quarter because of sharp reduction in my healthcare business, which has got pushed to Q2, and we have already started billing that, and last month we did 10 crores. The loss of EBITDA because of a sharp decline in healthcare business in this quarter, if I was to compare it with Q1 of last year, would be 17 crores. If I was to compare with Q4 of last year, would be 14-15 crores.
Understood. That is
because of the sharp decline in the healthcare business. We did 55 crores in Q1, we did 45 crores in Q4, and we did less than 15 crores in Q1 of FY2023-24. So the delta is 40 crores for Q1 and 30 crores for Q4 comparison. And healthcare business is about a 40, 45, 48% gross margin business. So on a 40 crore, a 45% would translate to 17 crores. On a 30 crores, it will translate to 15 crores. So ideally, if my healthcare business was as if we had envisaged, I would have been sitting at an operating EBITDA of about 57 to 59 crores. Just as a sort of explanation, we are not there. And with the healthcare business reviving, and this quarter we expect to do 30 to 35 crores in healthcare and then build on it in the subsequent quarters. I think this one-off aberration is like a bad dream, and we should recover, or we will recover.
Thank you, sir. That was very, very clear. Just one last question. If you can talk about your overall order book for the next 18 months, and if you can give some texture in terms of which are the categories and segments that are likely to contribute to that.
The order book as of 30th of June is 3,500 crores, which will be for about 2,000 odd crores, 2,200 crores is to be executed over the next 1 year, and then we keep getting the orders. The composition, the texture of the order book would be spread across electric mobility, combustion, industrial, consumer, almost in the same fashion of 25 to 40% would be the contribution of each one of the sectors. And export order book is also, now with this new business which you have got, is strong. And we are also going into a significant growth in the railways, the numbers being very, very small. The base being small, hence I say it's significant. It may not be significant in relation to the total turnover. But again, railways is a platform which we are creating this year to grow in the coming years.
Understood, sir. Understood. Very clear. So just one last bit.
Sorry to interrupt, Mr. Bakul. We have several participants who are waiting for their turn.
Sure, sir. Thank you so much, and congratulations on a good improvement in working capital. Thank you, sir.
Thank you.
Thank you.
We'll take the next question from the line of Aniruddha Joshi from ICICI Securities. Please go ahead.
Yeah, thanks, sir, and congrats for a great set of numbers. Sir, two questions. One, how should we think about the healthcare business? Because I guess the products that we were supplying were going in a consumer product like toothbrush. So obviously the customer, the large customer that we had must be procuring it from somewhere. So has the customer gone to any other competitor of us, or is there any issue? So how should we understand about that business? That is question number one. And secondly, the acquisition seems to be just too excellent and very accretive. So while the margins are good, the growth was also, last 2 years, CAGR was also 80% plus growth. So if we look at the valuation at which the existing promoters has sold to us is less than 10 times EV/EBITDA on a FY23 basis. So it will be much lower on FY24 or FY25 basis. So what was the exact reason for selling out at such a lower valuation? Because it's not that he was not growing. He was growing at a very good rate of 80% plus rates. So these are the two questions. Yeah, thanks.
The customer has not gone to anyone else. The business, 100% business is still with us. In fact, in the Q4 period, the customer has committed more capex for automation for this product. This customer has gone a lot of reorganization, and you see at times even big companies falter on their planning. So obviously his supply chains were choked in terms of the inventories. The customer had gone for a reorganization, and in big organizations, whenever there's a new team which comes in, the first thing is to have a status quo, check up the things, clean up the balance sheet so that the team starts on a clean slate. If it keeps on carrying legacy issues, so there are a combination of 3-4 factors, but be rest assured the customer has not gone anywhere. It's 100% with us for this product because he's committed and is committing more capex for automation, productivity improvement and features. So that takes care of the first question. On the second part, the JDHL, I think our M&A team did a phenomenally good job of stitching in a deal which makes sense to both the parties.
Just to add to what Mr. Gujral says, Anirudh, I hope you don't have a problem if the deal is good. Because if we do a bad deal also, there is a problem, and if we do a really nice deal also, there is a question that how come he sold it. So let me be a little serious and ask you why he sold it is because the growth as Mr. Gujral explained, when he says 70 or 80% growth is on a small base. When you want to grow to a 2,000, 3,000, 4,000 crore company in medical devices, you need a strong platform, you need a strong partner, you need a strong balance sheet to approach larger clients in US and everywhere. And that's why we told them that if you really want to make a platform and build your current shareholding to a level, let us come in at 51% and you will grow your 49% along with it and you will recover everything. I think that's the crux of the matter, is that how the partnership, you may look at 51-49, but it's more of a partnership where both the shareholders will work to make it as a real big platform of medical devices. That's the vision. So it's not that we've done some deal and he's given us cheap or he's cheap. Yes, it looks reasonable because there will be enough efforts from the entire Syrma team. As Mr. Gujral very correctly said, a lot of efforts will go from our side to make this happen. And if you look at it, I have left off 50% or 49% of value to them because it's going to be co-created. That's why the deal is looking so, on a singular basis, so attractive.
What the overall scheme of things is that when anyone evaluate, is 100% giving me more valuation or 49% if I grow the business significantly. And in this case, it was a second alternative that with our bandwidth and their capability on technical, they would not have grown to a 5,400 or sort of 500 to 1,000, 1,500 crore medical devices companies because they didn't have the management and the financial bandwidth. And they are senior people, more sort of comfortable in the lab environment rather than on the road creating business. So I think going forward, their 49% would give them a phenomenal leg up in valuations because of the growth of the business. So it should not be taken off as a one-off transaction. Overall, going forward, I think both of us would benefit from this tie-up.
Thank you. We'll take the next question from the line of Rahul Gajare from Haitong Securities India Private Limited. Please go ahead.
Yeah, thanks for the opportunity. I have two questions. One on the order book side. Now, you closed the fourth quarter with closer to about 3,000 crore. You've got about 3,500 now. So in this particular quarter, you've got about 1,100 odd crore rupees of new orders. Now that has a bearing on the profitability of the future quarters. So could you just break up this 1,100 crores into various segments where you've got it from? Which are the segments which are, having the lion's share of the new orders that you've got in this particular quarter? So that's the first question.
So if I say the breakup of the current total order book that way, so broadly 25% is towards automotive sector. And then there is about 40% which is for consumer sector.
Including ODM.